All right, so let's follow Starbucks. Who knows this company?
Everyone.
Everyone. That's why I chose this company, because majority of you know this company, and
It's so popular in Asia.
yeah, absolutely, it's a huge multinational company. Now, the reason why I took you might remember what was happening with it in 2006, 7, maybe. Okay, maybe not, but let's have a look. Now, company was started in 1987. That's the growth rate from $2 to 42, 41, and then it collapsed to $7 from $41. So it's like 6 times, right? Now the question is, why? Why do you think it happened? That's 2006, that's 2007, that's 2008, that's 2009, and then start growing.
I don't know the inner story, but it's a very competitive market.
Cool.
It's a very competitive market. It's hard to sustain.
So what do you think, competitors came here?
Yeah, because the competition is strong.
All right, okay. One reason. Any other reason?
Internal.
What internal? What?
Something must have happened with management or lawsuits or something like
Okay, okay, great. What else? You're thinking now to allocate your $10,000 there or not? Now, what do you want to know? Why the reason? What can you imagine?
2006.
Huh?
In 2006.
In 2006, for example.
Long time ago.
So you need to understand what happened to this company. We are going to look at this now, but before we look at this,
When the stock crashed, 2000,
that.
when it crashed,
okay? So all right, I'll tell you now the prehistory of this company. This company, okay, before I go ahead here, that's how I look.
I think something to do with Iraq or something.
That's value line report. So that's financial statements. So if you look closer, you can see from 1998 to 2015. So how many years of financial data here? 17 years, right? Is it good to have in your glance 17 years of financial statement of what's happening with the company?
Is this on their website or something?
Yeah, you can download. You have to pay for the subscription, but yes, it's not free. But the thing is that we're going to look at this area. Okay, that's the fall. You can see the same chart. That was the maximum price is $40, and it's fell to $7. Now the question is why. And do you remember I told you that we're trying to find companies which have temporary solvable problems. Okay, if the problem is not solvable, we're going to stay away. If it is solvable, we're going to stay with this company. Now, let's have a look. Now, there are 2 parts of this value line report. Red one is per share. Below it, it's for the company as a whole. So here sales, for example, here $80,450 million per company. Here it's $24 per share. That's the level of their sales. Okay, we're going to look at share like level. It's easier to understand. Okay, Warren Buffett probably will be looking here. Now, and we're going to look before 2006 and further in order to understand, was it a good time to buy this company or not? What's the reason? And we're not going to go really deep in this. I'm going to just few things which we have to take into account, but even by looking at those parts, you might say, oh, it's interesting. All right? Now let's have a look. First, the sale growth. Do you think the level of sales is important?
Yeah, it's
The higher it is, the better. Now let's have a look. Now, I will read it from here. $1.83 per share, then $2.29, then $2.88, then $3.49, then $4.24, $5.18, $6.66, $8.30, $10.29, $12.75. Interesting enough, price is already start falling. The growth rate on the sales is still continue. So it's $10.29, $12.75. In 2008, $14. The price is already near $7. The sales level is still high. It's growth. Okay, and here the drop. The drop less than 10%, 5%. Okay, here the sales level. Okay, maybe like 7% drop in sales level, and then keep growing. Now the question is, sales are growing. Why the price of the stock collapsed? What's another parameter which is important?
Maybe they bought more properties.
Profit, like, okay, yeah, you're right, that's why they were selling, but the thing is that sales is one parameter, profit is another one. we're interested in what? Not
Profit.
how much we sold, how much we can put in our pocket. Right? So the next question, it's a third line, earnings per share. Again, here we can have net profit per company. Okay, and we look again. 21 cent, or 11 cent, 14 cents, 18 cents, 23, 28, 34, 48, 61, 73, 87 in 2007. So it's still making more money than previous, but the price is already fallen. Right? And then it's dropped to 71. So to the level of 2005, 6. So it's practically the same. And then keep growing. So the drop in earnings was only 20% here. But the drop in share price was 6 times. So it's like from $60, we say, to $10. Why? So do you remember I was showing this graph where the price
Value.
is high and it goes below the value? So that's where the question is. The value dropped here as well because the earnings of the company dropped down. But the price of the stock went down much, much, much lower. The question is, why it happened? And here, of course, if you follow this company, you will understand. And you don't have to be like highly educated, high degrees of no, common sense. Now, the thing is, owner of this company, who started this company, who bought this company and developed it, he retired in 2002. He just stepped out. He still was alive, but he stepped out of the company, hired the managers. The remuneration for managers depended on the amount of stores they opened. Now, if your remuneration depends on how many stores you open, not on their profitability, what can happen?
You buy too many stores.
You start opening stores without taking care about their profit. It's not their business. They're managers, they work for you. Now, that's what was happening. That's why the sales level, when the profit started dropping down, the sales level is still going up. Because
How do you know that information?
you just read.
Oh, so it has a...
It's all publicly available information. Okay, so that's you can go and read. It's all there, and so that's what was happening there. Now, he stepped back in 2007. He came back to the company. What he started to do, because when he noticed this, he noticed that profitability per store started decreasing. There are only 2 things can happen. First, your margin decrease, or you have high cost. And that's what happened. They hired too many staff in each store. So he came and he started, first his request was closing stores, unprofitable stores. And then firing people, providing the training, optimizing the workforce in their place. Now, how do you think media took it?
Starbucks is closing
Closing down.
Absolutely. Starbucks closed the 3rd store within the next 2 months. They fired blah 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 people. Now, what happens to people who don't read financial statements? What do they do with stock?
Panic, sell.
Sell.
Company going down. That's what they do. Now, as an investor, if you read this and you listen what they're saying, why they're closing stores, and the management is telling you, the owner of this company, we're going to close those stores which are not profitable. We're optimizing our workforce. That's why we're hiring people, because we're providing training in order to reduce our costs. As an investor, is it a good thing for you or not?
Yeah.
It's a bloody perfect thing, right?
They try to make it
Profitable
good.
again.
Profitable.
So that's the thing. So, and it's common sense. You don't have to be super smart or super educated in order to do it. It's all normal thing. That's what started to do. And the thing is that they closed 5 stores, but they opened another 1. So they keep opening new stores, like new coffee shops, but in profitable location.
But if you're living in Sydney, you might think the company is closed because they disappear from here.
Starbucks, they have here a lot of stores.
Very few.
Joe Street in Sydney. There's a few more around too.
Yeah, of course, there are a few of them. Not
Yeah.
one, there are a few. Yeah, but they opened only where it's profitable. They don't show we're going to be everywhere that people know us and let it be unprofitable. No, they take care about your profit because you're owner of the company. You're a shareholder. For you, it's important how much money you can put in your pocket. That's and you know it when you read about the reports. Every company has like 3 financial statements and then additional not financial statements. Financial statements, who knows what? Who can tell? Like balance sheet,
Yeah, profit and loss.
profit and loss, what else? Cash flow statement,
Yeah.
and the fourth one, not financial. It could be management report. They actually, it's not, it goes through that. So they tell you what they've done and what their plans for the next future. That's how you know what they're going to do. And the thing is that if you listen them and they told you, oh, we're going to do next year, blah, 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 right? And then next year you're sitting and listening them and you haven't done all of it. What do you do with them?
Like level.
You fire them. You're owner. That's what happens. During these meetings, they fire the management. Look, you promised this, you didn't do it, we fire you. So management, they promise what they intend to do, and they're trying to do it. Of course, there is even a certain rate here. You can assess how management is precise to their promises. In some companies, it's pure mystery, never right. In some companies, it's just nearly exact. Okay, so that's the thing. Okay, that's understandable. Now, we look at quality like that. We understand how a company is like good from point of view, if it is making money, what their decision, if it's growing, etc., etc. But the next thing we need to look at the price. Like girls know, if you like a dress and it's a perfect dress, you don't always buy it, right? You wait until it's middle season sale, and that's when you go and buy it. Like my girl, she would never buy it, for example, in May, because she knows that in a month's time it's going to be a big sale. She already knows what she wants to buy, and she goes to buy it when the sale starts. I have a friend who buys shoes 2 times a year: Christmas sale and middle season sale.
But most people, I think, they go by emotions, you know.
Absolutely.
Especially the females. They don't care for the price, they want the price.
Especially if it is husband money, right?
I think got a rich,
So, no.
got a rich boyfriend.
No,
Otherwise-
yeah, you're right, you're right.
Otherwise,
But
in
that's the
general-
stock market, similar stuff. There are majority of people emotional stuff. So if you want to make money, you have to stop being emotional, have to be logical. Patient, that's it. All right, so another thing which I'm going to show you, it's just from point of view price for the company and worth for the company. Now, who knows what price earning ratio means? Do you know?
Pardon?
Price earning ratio.
I don't know why.
Price earning ratio.
Price earning ratio. Okay, I'll explain it. Now, imagine that one particular shop, restaurant, which you might consider to buy, generate a revenue $1 million annually after all expenses, everything. So
Great.
pure net, $1 million. And the owner of this store is putting the price to sell the stores for $10 million. So the question is, how many years, assuming that the level of profit will stay like that for years to come, how many years you have to keep the store in order to make your money back?
10
10
years.
So basically, price earning ratio is that's the 10. Okay, so it's how many income levels within the price now. So how many $1 million?
ROI, return on investment?
No, it's not
No.
return on investment. It's price earning ratio. Okay, it's a
How much
coefficient.
when you put in, when you increase?
Yeah, return on investment is how much you invest and how much you got back as well.
Okay.
So, okay.
It's a break-even point or?
No, break-even point is different as well. So there are a lot of coefficients. Altogether 24. So we're going to cover only one today. Okay, price earning ratio. Basically, it's easier to understand, right? So if another store manager generate $2 million in profit, they're close to each other, but one is slightly bigger, maybe different product, and they generate $2 million profit, and they sell at $10 million profit, at $10 million price. They're asking, how many years you need to keep this store? 5. So which is when the price earning ratio higher or lower is better? Lower, right? So simple. Now I'm going to show you how much people were happy to pay for Starbucks, and you will understand everything straight away. Okay, that's simple as that. Now, before I continue, in average on the stock market, if you go on the stock market right now, the price earning ratio will vary for different industries, but from, let's say, 16 to 24. So average somewhere around 18. So you pay 18 times of the earnings for the stock, and it could vary. And you just told that the lower it is, the better for you. Okay. Now, this line, average price in ratio. See here. Okay, this line. That's how much company was sold for on that level. Now look at this. 46, 50. So if you buy here and company will create the same revenue, the same sales level year after year profit, you will have to wait 50 years to get your money back. Is it a good deal?
No.
Not at all, right?
Thanks.
Why people, the question is, why people were happy to pay this amount of money? Why do you think?
Too.
That's profitable.
Because of growth. Imagine if that first store, which generate $1 million in profit now, they will tell you next year we're going to generate $3 million in profit. So from 10 price in ratio, next year if you look future price in ratio, it becomes 3 and 3. Right? Because it's already after that, it's only 3 years will take you to cover this investment. And they'll tell that year after that we're going to create $6 million of profit. And in this case, you might say, oh my goodness, the second shop, they're going to have stable $2 million profit year after year, never grows. Whereas this one has the potential to grow. We're going to invest where? In the first one. Yes, we're overpaying now, but in 2 years' time, it would be much lower. That's why people pay 50 times. And we didn't calculate here, but if you calculate here, you will see that the growth rate on sales and earnings on Starbucks, it was practically varies from 30 to 50% annually. And here in 2005 and 6, it slowed down. Instead of 50, it becomes 20. And now people not happy to pay 45 times. What they started to do, taking money away from there. And it's triggerously reducing the price. And then the owner of the company start closing stores, firing people, and it triggered another thing, emotions. And on top of that, here in 2008, what happened? This gray area, what do you think it is? Crisis, IGFC. On the top of that. And everything was on discount. So this company sunk even lower on this moment. Now, and let's have a look how much pricing ratio. Now I'll ask you to calculate in a different way. The profit is 71 cents during this year, and the lowest price was $7.10. What's the pricing ratio here? The profit is 71 cents, and the price $7.10.
10, 1 to 10.
10. It was 45, 50 before, and now it's 10. Now, how do you think, what is better? You just told yourself that the lower is better. And if I tell you that in average on the stock market,
Was 18.
you understand? So if it's average $18, right? So what happens if the profit of this company stays the same level? If this price earning ratio has to adjust again in the future, so the price of the share has to go, what's the percentage up? 80%. So if you buy a company at this particular moment, you're going to make 80% profit. How long does it take? You don't know. You can't know. It's not the crystal ball, because emotions, they might, if media keep driving all these emotions, it even can sink even lower, right? Your question is, if you bought it and you're confident in this company and you know that management is doing all this right stuff, it might take not 6 months, maybe 8 months, maybe 12 months, but you know that then the stock market will adjust it to the proper value of this company. And that's what happened. It went all the way to $78 here. So you put $7,000, it becomes $78,000. You put
It's still gambling in a way, because I mean, even though the management say they're going to do all of these things, what if that management leaves or gets fired or the guy gives up? And
absolutely.
So really, you're still gambling.
You're still having a risk.
The risk is the.
You're still having. It's like in any way. Now the thing is here, it's like a business. When you're starting your own business, I don't know who has their own business here. You have, yeah. You have your own business. Now, are you certain that you're going to generate profit there and there? You see, so there is always uncertainty, and still people go and start businesses, right? Because there are certain advantages there. So here you become a business owner. The only difference here, with a smaller level, you can't make decisions. Only when you vote for directors, you can hire them or fire. If you have certain amount of money and you become more than 5% shareholder, you can go on the directors board and you can manage this company.
Yeah, but the difference in your business is that you can make instant changes.
Absolutely right.
This you're tying up your funds and sitting on it for endless amount of time. You don't know, and you don't
Absolutely
know how
right.
long it's
And
going to take.
that's a very good point, because that's the disadvantage of value investing. And that's what happened quite a lot of time, because people, when they put in stock and it doesn't go up straight away, they don't know what to do.
And money is tied up there.
And money tied up. And if they need cash for whatever, holidays, maybe they lost their job, they have to sell below the price. And that's why the second part will come up with options. That's what you do to generate the cash and cover all the stock. Okay, but we'll talk about. But in this case, in any way, you reduce your risk, because risk on stock market is potentially how low can it fall. That's one question, and how far it can rise. And you have to always find that proportionally the level of growth is much, much higher than the level of fall. So many companies there, great companies, their price-earning ratio 18. Okay, but their potential of growth compared with the growth rate of the company. The company earnings grew 10%, it means that the price will grow 10%. But if you find something like that, when it's discounted 80%, yes, of course, it can drop more, go to 60 cents of profit. But if you adjust then, even to normal pricing ratio, it has to go 80%, even if the earnings will stay the same. So that's where you have to understand the business and the company as well. Now, another very good point what you mentioned about the management. What if somebody tells you, Facebook, for example, yeah, the guy there, what's the percentage of the company he owns? Do you know this? Like about 50%.
51%.
Something like that, yeah. So now, if you see that management has no shares in the company, is it a good sign or not? No. If they have, like, for example, worth of $1 billion worth in that company, is a good thing.
Mm-hmm.
You know that management put their own money where their mouth is. So it gives you certain confidence, right?
Mm.
So, and it's all publicly available information. Here, you can see it here. Officers and director owns 3.3 of common stock. 3.3, if you take 52 billion worth of the company, it's 1.2 billion, 1.5 billion dollars owned by management. Kind of big amount, right? So it's good to understand in this particular case. All right, so we kind of took quite a lot of time on that part. Another thing which I always look, that's value line gives us a percentage of growth, how much company predict will grow in the future. That's how much dividends they pay, that's their quarterly stuff. And that's if you don't know about company anything. For example, somebody told you, oh, I know this great company and I think of investing there, you don't jump and do it. You download this worksheet and start reading it. And here you can find out quick information about it. If you like it, you go further and read more. But for me now, it takes about 2 minutes to look at the company.
And did you say you subscribe to this thing?
Yeah.
Is it like you subscribe to one thing, or is only specifically as a Starbucks?
It's
or
about
is it...
1,700 companies.
Oh wow.
So it's actually more 6,000 companies, but 1,700 huge companies, like big companies.
Who's that with?
Value Line.
Value Line.
Value Line. This company actually is one of the biggest in the US. The only disadvantage that they manage only US stock. Now they started in when it was a Great Depression in the United States, and there were a lot of Ponzi schemes, and people were buying stock which they have no idea. They rely on brokers. When they call a broker and they tell, have you seen Wall Street, where they lied to customers? They said, oh, this stock is great, it's going to grow, but they have no value. They were selling garages, right, with no assets, nothing, no profit. And so Value Line stopped this company, and they were providing unbiased information. It's not propaganda of these businesses. Value Line assess it individually, independently. Okay, so that's how it goes.
I have a question. Sometimes the company is internally not doing well, and the management, they want to sell their share. So they manipulate with this financial statement and datas, so they can do it.
Now, at the moment for management, it's really difficult to manipulate because of regulations. It's more difficult in the United States and it becomes more difficult and more. For example, if you're a manager of the company and you want to sell your shares, you don't sell them today. You have to tell, I'm going to sell shares on that day in the future. So, for example, today, what is 5th of July, you say, 1st of August, I'm going to sell, and you tell the amount of shares you're going to sell. For example, I'm selling 100,000 shares. And you don't know, you as a manager of the company, you don't know what price is going to be there. You already set your order. So the price can be high, but maybe it collapses and you sell much lower. So management can affect the shares. And if you as a manager tell somebody that, look, tomorrow is going to be a report, and report is great and fantastic, and the share price will jump up. And if you do it, you'll go to prison. The guy who does it goes to prison, and you lose all your money because they would be taken from you as well, like a fine. So it's really, really strict right now. So internal trading, which was like 100 years before, it's gone completely. I mean, not 100 years ago, like 20 years ago. So now they monitor it. A few times I was called from the United States, and they told me, can you explain why you created this trade on that particular day? It looked for them suspicious. So I explained them. They look at my pattern, and they said, okay, fine, go ahead, trade that.
What if you don't give a proper reason?
Usually you give. I
Yeah,
explain.
you do, but sometimes there are
So
people,
that's why they will.
there are people who are doing at random, buy it without proper
In this case, they
reasoning.
will investigate you.
Then you say that I just took a chance. What
So
do they
then
do?
they might go further. They will check your phone calls. In this case, did you talk to somebody from management of this company? Etc. Of course, they will deal with you when you deal with bigger
It's my
amount.
right, right? Why are they asking us? Because I've paid the money, I bought it as per the legal, and
So
why not
they're
they-
trying to just keep it.
Just
Okay.
in case of insider trading, that's all.
Yes, just inside the trading. Not going there. You have to ask them why they are doing it. Kind of find not doing it.
Just
But,
the guy on the news just wants to go to the jail.
so a lot of people kind of they keep an eye on that. Okay. All right, guys. What
So
time
does
is
it
it
mean that
already?
is it risky if people are
Well,
asking you, or
Huh?
is it risky to invest?
No.
No, this is the management, the manager.
It's
He was talking about.
no. This situation happens when you have really unusual trade with big volume
Oh, yeah.
just before certain earnings and whatever.
Even now, before 9/11, whatever the trade happened,
Yes.
they investigate
Yes.
it.
All right. Okay, guys. Just quickly summaries. The precondition for Starbucks growth. Now, first of all, because it has a history of high growth before, when it fell down and started growing again, people who already invested before and they believed in this company, usually psychologically you think, oh, it has to go to the same level. That's very often happens. It's like believing in imagine you have a classmate who always was making money, and now this guy got bankrupt. Do you think he will stay bankrupt all their life, or he's going to make money again?
I don't know, Trump.
Like Donald Trump, for example. A lot of people who know how to do it, they do it. So that's why when the company collapsed and then they made certain decisions and changes, investors, they believe it can go to the same level. So that's why when it was 7, people start buying it again. Okay. After that, publicly visible company, because as soon as they stopped firing people and stopped closing the stores and start opening, what media start telling? Oh, we were wrong. Look at this. They survived. Blah blah blah. So it's again information available to everyone who sold. They say, oh my goodness, I have to jump back and buy it. So that's the way it happens. Then relatively high price before that. So it was 45, and it's when it dropped to 10. People tend to move it again to at least to average straight away. Pessimism among public in 2008. It was at that stage. Everything was low. So as soon as the economy improves, generally prices go up as well in everything. Then temporary solvable difficulties with Starbucks. The key word is here solvable
So,
and temporary. Okay, and then I believe that it was unreasonable price fall. Okay, what we also need to do in this particular moment, we need to analyze the risks. You have to. So you who told about competition? Yeah.
So I will never buy this company share because when they made money, they were in progress. That time the competition was not this much. Now a lot of other franchise came into the market. It's not that market where they made the money before.
So you have to. It's a very good point. Buy companies only when you're confident. If you're not confident, stay away from them. Now, First of all, the main downfall could be if company will tell you we're not going to expand anymore. So you know that they're not going to grow. It's one problem for you. The second one, the competition among industry. So if the competition is high, and especially there are competitors which killing them, it's very important as well. And only when you understand it, for example, if you go and, for instance, Glory Jeans start opening coffee shops just across Starbucks. Two competitors, right? And you can see that as soon as Glory Jeans opens, everyone goes to Glory Jeans. Assuming, right? So what it might tell you? Better invest in Glory Jeans rather than, for example, Starbucks, right? If you still want to do it in this particular industry. So you have to analyze competitors as well. So it's part of your research. When you find the company and you like it, always look at who competed with. Okay, that's the important part. Now you need to understand these reasons, how strong they are, and how profit will be affected when these reasons are there in place. And if you manage to do it, kind of it's pretty easy to understand. It's like in any business. If you're running your own business or you're working for some business, you understand how to compete, you develop certain values, etc., etc., etc. So basically, what we're paying attention, another thing, level of debt. Do you think that is important? If it's too high, it might kill the company, right? So access to cash. So if, for example, they don't generate enough cash, for example, they sell a lot of products in credit, and they have to pay salaries and etc., and they don't generate enough cash to pay salaries, they can be close to bankruptcy, even if they're creating enough profit. But it's postponed, okay? In other sales and earnings, we looked at this company future plans. You read it from from reports of their management, and then management actions, what they actually do, not what they're saying, okay? So, and we make our decision based on logic, not emotions. That's the key, all right, guys? So if you remember that, before you invest in any stock, anywhere, first logically decision. That's why clubs are so perfect, because in a club, you have the company, you come with another guy who knows the stuff. It's not your neighbor who has no idea about the stock market, but happy to give you advice to buy or not to buy. In our club, people who already know the stuff. They went through education, they understand the product. You sit down with them and they tell you, okay, tell me about their competitions. And you say, oh, I didn't research it. Okay, tell me about their pricing and racing. Oh, I didn't look at this. Or tell me what their plans in the future. Oh, I didn't look at this as well. Okay, what are you asking? Have a look. So it's like, you know, when you have a buddy who can help you, who can critically ask you certain questions, and after that you go and just point out and answer it. So that's the key. And that's how we work.
Sorry. So this club that we join, do they teach us one-on-one?
The way we do, and I will talk about it a bit
Okay.
later, okay, so if we continue, just not to jump ahead. So do you want to try